Hi, Paul Hudson again from Hudson Gore Financial Services, and we're here today to talk about risk profiling. What is it and why you should understand it. Now, all investments except amounts held in cash are designed to make a return and are subject to risk. It means that as well as making money, there's also a chance that you could lose it. You might also think of risk as a possibility that your investments don't achieve your financial objectives. As a general rule, the bigger the potential investment return, the higher the investment risk, and the longer the suggested investment time frame, as the graph you're seeing indicates. What type of investor are you? Before investing, you need to decide how comfortable you are with investment risk and how much risk you are prepared to achieve for the returns you want. That is often referred to as your risk profile. How comfortable would you be with short-term fluctuations in the value of your investments? Understanding how the different asset classes work can be a big help here. Education is always the key. It's important you split your risk profiles depending on your time frames. You might need 2 or more risk profiles, one for your super and one for other specific investments. Why? Because superannuation will generally be longer term investment, and your time frame for investments outside your super can differ, largely determined by the objective and intended purpose of the investment. For example, if you're investing to save for a house deposit in the next 12 to 24 months, you'll probably be less willing to take a short-term loss. But if you're investing in your super and not looking to retire for 15 years or more, you might be in a position to ride out short-term fluctuations in your investment value in order to aim for high returns over the longer time. Hudson Gore risk profiling is a process for finding the optimum level of investment risk for our clients, considering the risk required, risk capacity, and risk tolerance, where risk required is the risk associated with return required to achieve our client's goal from the financial resources available. Risk capacity is the level or financial risk our client can afford to take, and risk tolerance is the level of risk our clients are comfortable with. Risk required and risk capacity are financial characteristics which we can calculate using our financial planning software. Risk tolerance is a psychological characteristic which is best determined by way of a psychometric test that you'll be asked to complete as part of your initial financial assessment. Risk profiling requires each of these characteristics to be separately assessed so that they can be compared to one another. Risk capacity and risk tolerance both act separately as constraints on what our clients might otherwise do to achieve their goals. Risk required. Given there is a mismatch between risk required, risk capacity and risk tolerance, it's our role to guide our client through the trade-off decisions that are required to reach an optimum situation. It is then important to review your risk tolerances with your Hudson Gore advisor ongoing and align with both your time frame and your objectives. As an example, the chart you are seeing shows asset classes over the last decade and their performances. Investors that are in equities and sold in 2008 during the GFC due to fear of further losses or incorrect time frames would have received far less than investors who were able to ride out the volatility. In conclusion, having the correct risk profile is a very, very important part of financial and investment planning. As always, we're here to help. www.hudsongore.com.au or call us on 02 93 88 9033. Thank you.